It's another week on Business Morning. Good morning and welcome to the program. I'm Chimeze Obi Iwabo.
And I'm Ladi Williams. Thank you for joining us. Let's take a look at what's in the news. Saudi Arabia and the United Arab Emirates cranked up the tension in their OPEC standoff as the rare diplomatic spat between longtime allies leaves the global economy guessing how much oil it will get next month. The bitter clash has forced OPEC Plus to halt talks twice already, with the next meeting scheduled for today, Monday, putting markets in limbo as oil continues its inflationary surge above $75 a barrel. With the group discussing its production policy not only for the rest of the year, but also into 2022, the solution to the standoff will shape the market and industry into next year.
The fight between the two key producers broke into public view on Sunday, with both countries which typically keep their grievances within the walls of the royals' palaces airing their differences on television. Riyadh insisted on its plan, backed by other OPEC Plus members, including Russia, that the group should increase production over the next few months, but also extend its broader agreement until the end of 2022 for the sake of stability.
Meanwhile, oil prices fell this morning, with Brent dropping after 4 days of gains as investors and traders awaited the crucial talks by OPEC Plus following disagreement within the group that could lead to major producers pumping up volumes to grab market share. Brent crude was down 40 cents at $75.77 a barrel after falling 1 cent last week, the first weekly decline in 6. U.S. oil was down by 30 cents at $74.86 a barrel, having risen 1.5% last week. The sixth consecutive week of gains for the contract.
The Organization of the Petroleum Exporting Countries and its allies, known as OPEC Plus, voted on Friday to increase production by about 2 million barrels a day from August to December 2021 and to extend the remaining output cuts to the end of 2022. But objections from the United Arab Emirates prevented an agreement. It was a rare public disagreement between members of the group, with national interests increasingly diverging, which is impacting OPEC Plus policy as oil users want more crude as their economies recover from the COVID-19 pandemic. Well, the meeting continues today.
And back here, Nigerian Association of Chambers of Commerce, Industry and Mines and Agriculture has welcomed the passage of the Petroleum Industry Bill. The new president of the association, Ide John Udegbala, says he hopes that the passage of the bill will bring the much-awaited and needed reform of the Nigerian oil and gas sector for improved involvement of the Nigerian private sector in the oil and gas sector and improve confidence of foreign investors.
The Nasima president has called on all stakeholders to work concertedly to ensure that the bill will improve the life of the host oil community, ensure sustainable development of the environment in the oil-producing areas. According to him, while the passage of the bill is a big relief, its faithful, transparent implementation is key to ensure its desired objectives.
And the first half of 2021 is over. Its second half, and most economies and businesses are taking stock of their performances and re-strategizing for the remaining part of the year. First half of the year saw the Nigerian economy sustain a tepid recovery in the first quarter, posting a year-on-year GDP growth of 0.51%, consolidating the exit from recession in the fourth quarter of 2020 after the easing of COVID-19-induced restrictions.
Well, we will be looking at Nigeria's economic performance in the first half and, of course, outlook for the rest of the year. The immediate past Director General of the Lagos Chamber of Commerce and Industry, Dr. Muda Yusuf, joins us next. Keep it here with us. This is Business Morning. And to look at how the economy has performed in the first half year and, of course, the outlook, we're being joined by Dr. Muda Yusuf, the immediate past Director General, Lagos Chamber of Commerce and Industry. Thank you very much for joining us, Dr. Yusuf. And by the way, congratulations on your successful completion of your tenure as the DG of LCCI.
Thank you.
Congratulations.
Thank you.
Well,
thank you. My pleasure. Thank you.
Right. So what's your general assessment of the economy in the first half of this year?
Yeah, thank you again, Chimeze. Well, the assessment of the economy will depend on what metrics you are using, because operators or stakeholders in the economy have different perspectives as to what we regard as the economic performance. On account of GDP, for instance, you would say that the economy has improved slightly, given the fact that we have exited recession. And in Q1, we posted a GDP growth of 0.51, which is also very fragile, but it's still much better than where we are coming from. So from the point of view of the GDP performance, I will say that the economy has done fairly well, because the growth is still very fragile. And when you relate the growth to the population, you know that there's a big gap. Then on account of the investors or business climate, that's the perspective of investors, it has not been okay at all. The investors still face very serious challenges with regard to the situation with investment, whether domestic or foreign. All these issues that we have always grappled with are still persistent. Issues around energy costs, as you know, the cost of diesel now is around 280 naira per liter. And a situation where we have challenges with public power supply and all of that, even the cost of gas is also going up. And even access to gas is also an issue. So energy issue remains a very big problem in the first half of the year. Then, of course, the foreign exchange issue has also remained with us. A lot of investors still complain a lot about the foreign exchange situation. And of course, the security environment is also a big issue in the business environment, affecting practically all sectors. But of course, it affects some sectors much more than the others, particularly those in agri and agro-allied industries. Those are very seriously affected. Okay. Then, of course, general purchasing power in the economy is also weak. So a lot of industries also complain about high inventory, low margins, low sales, low capacity utilization. So from the point of view of the investors, I'm talking about the investment climate now, I don't think there is anything to cheer between January and now. But I must say that with the gradual recovery of the economy, some sectors are beginning to come alive, especially the hospitality, the aviation, and the entertainment sectors. They are beginning to come alive gradually, at least within the first half of this year. And to the average citizen, because the economy is not just about the GDP or the investors, it's also about the people, the ordinary man. The ordinary man will not rate the economy as performing well at all, particularly because of the high cost of living, because of this inflationary situation.
And
so
Dr.
from
Muda,
these perspectives, you can see that you see different outcomes in terms of assessment of performance.
All right, but we had one positive, though. We had inflation taper, in May compared to April. What does that tell us?
Well, that is good news. But again, inflation is still generally highly elevated because we are talking about an inflation of about 18%. 18% is still very, very high. And to make matters worse, the food inflation is around 23%, which is why there is so much cry about poverty and about hunger in the land. Between January and now, there are instances where prices have gone up by as high as 50%. In some cases, almost even close to 100%. So yes, we have seen a marginal reduction in inflation. We had a very sharp spike in inflation up until March, then from April to now, a gradual deceleration. But its prices, the 18% inflation is still very high by any standard. And this has implications, serious implications for the welfare of the people. It has serious implications for poverty. It has serious implications for the cost of production, the operating costs, the profit margins, and so on and so forth. So the inflation situation is also very, very worrisome. There are all sorts of theories as to what are the key drivers. The stronger theory is that, well, these are supply-side issues. But of course, we are beginning to see that there are also monetary issues. Because if you look at the rate at which the government is borrowing from the central bank, it has very serious implications for money supply, which has serious implications for prices as well. So we need to begin to look at all of these dimensions in order to be able to know how to tackle it, because we cannot afford to continue like this. The inflation situation is already creating a lot of tension, social tension, especially among the ordinary people. And we need to look at how we deal with it on the supply side and on the monetary side. And we also look at our policies, especially trade policy and all of that, and issues of the forex market, to ensure that we're able to scale up our supply and output, and also improve predictability of the economy, improve investors' confidence, make the environment a lot more predictable to reduce uncertainty. So all of these things are very critical, but really I must tell you that the inflation situation, even though it has decelerated marginally, is still a big issue, both for citizens and for those who are in business.
All right, let me take you up on what you said about the interest rate situation. So, do you think perhaps it's time for maybe the central bank to tinker a little bit with the policy rate when they meet later this month?
Well, it is very likely that will happen because inflation is still high. But I must say, and just as the central bank has also always said, that the situation in the Nigerian economy presents a major dilemma, even to policymakers, including the central bank. Because on one hand, we are still struggling with a growth that is very fragile. We are struggling with high unemployment. We are talking about 33% as at the last number. And on the other hand, we are dealing with high inflationary pressure, which is affecting, purchasing power, escalating the cost of production, eroding profit margins, and so on. It's a policy dilemma. But I think that at this point, perhaps the CPM may also begin to look at, but more importantly, is to appeal to the fiscal authorities to moderate the rate at which we monetize fiscal deficit. Now, the finance minister just yesterday presented the MTEF, that's medium-term expenditure framework of 2022 to 2024. And one very striking thing about the numbers that we saw was that we are having interest charges on ways and means. Ways and means are the credit advances to government. Ways and means of about 480 billion as at May. Interest, we are not talking of the principal. This is also a very disturbing scenario. So we need to also look at the way at which the CBN also funds the fiscal deficit. It's very important, because this may also be a major source of the inflationary pressure that we are having, and the impact this is having on both production, exchange rates, and even poverty. So it's a dilemma, I must admit. Whichever way you look at it, I mean, you may worry about growth. We need to stimulate growth because growth is still fragile. You worry about inflation. We also need to look at to ensure that the inflation doesn't go out of hand. But I think that perhaps some steps will be taken to curb the inflationary pressure, because inflation at 18% is still very high.
All right, Doctor, let's look at the PIB passage. Now, what impact do you see this having on the oil and gas sector?
Well, first let me commend the National Assembly for what they have done around the PIB. It's very commendable. We expect that if the concerns of the investors in the oil and gas sector, particularly the upstream investors, have been taken into account in the final outcome of the bill, because I haven't seen what the final outcome is. Because during the deliberations on the PIB, concerns were expressed especially around the issue of the fiscal terms, because the oil sector today is not what it used to be years ago, because there's a lot of migration, there are a lot of issues around decarbonization, migration to renewable energy and all of that. So we need to put a lot of incentives on the table to encourage investment in the oil and gas. So I'm hoping that those concerns have been captured in the bill. If that is so, then we expect to see a lot more investment in the oil and gas industry. But for a long time, because of the uncertainty around the policy regime, because of very weak commitment to reforms in the oil and gas sector, we have not been able to optimize the benefits, the value that sector can bring to the economy. So we see a lot more investment in the sector. We are likely to see a lot more earnings in terms of foreign exchange. We are likely to see a lot more creation of quality jobs in that sector. And that may also help us to even improve our refining capacity, because the PIB has implications both for the upstream and the downstream. So if we have these reforms even in the downstream, we are likely to see a lot more investment in refining capacity, which will reduce the pressure on our foreign reserves, because we spend a whole lot of money importing petroleum products, which is why we are not getting the full benefit of even the high oil price that we currently have in the global oil market.
All right. Well, Mr. Yusuf, well, I must say that this is one of the most achievement of this administration, passing the PIB. Now, how do you now see the rest of the year ending for the economy? What's your outlook?
Well, the outlook is at first, because oil price is also a critical factor in what happens to growth outlook. And the projection is that oil price is likely to remain high for the rest of the year. I think for us as an oil-producing country, that is good news. So we expect that to impact positively on the economy. Of course, other things are also conditional. I mean, it depends on what we're able to do around other major variables impacting the economy. If we're able to progress and accelerate the reforms around our foreign exchange market, which we are beginning to see, but we are not yet there, because if you look at the NAFEX rate, which is about 410, if you look at the open market rate, it's over 500. So we still have a huge issue around disparity of rates, and we need to address it. We also need to address the issue of liquidity in the foreign exchange market. Those things are very key to recovery, and these are policy things. These are domestic variables. We need to deal with issues of security. If we're able to deal with it and deal with it very quickly, we're also likely to see an improvement in our agricultural sector and agro-allied industries. Then we have issues at the ports. The port is still in crisis. And there's no way you can function properly in the international trade arena if you have the kind of crisis we have in our ports. So getting the ports right is also very key. So these are some of the things that will influence the outcome. But I must admit that at least the oil price is going to play a major role in this. Oil output is also likely to play a major role. But we need to deal with all these very important business environment variables for us to be able to accelerate the rate of recovery.
All right, Dr. Yusuf, I will have to leave it there. Thank you so much for your time on the program. Dr. Muda Yusuf is the immediate past Director General of NASIMA, and congratulations again on your tenure.
Immediate past of LCCI, not NASIMA.
Sorry about that, the LCCI.
Thank you.
Thank you so much. All right. In the meantime, the federal government last week gave an overview of the 2021 fiscal outcomes and update on 2021 budget implementation. That's our conversation next in a moment. Do stay with us. This is Business Morning.
In the updated report of 2021 budget implementation for the period of January to May, federal government retained revenue was 1.84 trillion naira. On the expenditure side, 4.86 trillion naira has been spent. Let's bring in Ayodeji Ebo, now head retail investment at Chapel Hill, Durham, to weigh into this. Good morning, Mr. Ebo. Thank you very much for joining us on the program.
Good morning, and thanks for having me.
So the Ministry of Finance, Budget and National Planning published the Budget Implementation Report as of May 2021. What's your take on this updated report?
Okay, thanks. I think firstly, it's commendable for us to have like an update on a report because it helps us to assess the current position of the government and also to see what we should expect for the rest of the year. So looking at the report, you first looking at the item on the gross revenue, which is what is shared across the federal, states, and the local governments. You see, for government was able to achieve about 79%, able to raise just about 3.4 trillion naira relative to the expectation of about 4 trillion naira. And now coming down, looking at the federal government level, you would also know the government was able to achieve about 55% of that, which government was able to realize, or what got to the federal government was about 1.8 trillion rather, out of the expected about 3.3 trillion. And the main reason for this was the oil and contribution of the oil and gas sector to total revenue was around 50%, compared to the non-oil did very well, was around 98% in terms of the revenue. And the major item that impacted on the oil revenue was subsidy payment. Yes, it was not provided for in the budget, but we all know the government had to, oil prices have moved up significantly, and government is still taking that or bearing that burden of subsidy. So that impacted, and total deduction from federation within the first 5 months was around 428 billion naira, which includes the 13% derivation. So now looking at the cost level, you would also discover that that is also very high, but by and large, I think we saw that there's a bit of lag in terms of the revenue collection by the government.
All right, on the revenue side, looking at the revenue mix performance, would you say there's, any improvement in oil revenue performance as a result of the high oil prices?
Okay, thanks. Very interesting question. Yes, oil prices are above $70 per barrel, and when you look at the budget, the estimate was around $40 per barrel that was used for the budget. But we're also aware of the OPEC cuts that also capped what we can produce. So that's limited the oil revenue. So in terms of gross, yes, was still very impressive, was close to about 60% in terms of contribution. But when you now take out the net, because of the subsidy that we have to, the government have to pay, that reduces significantly what goes into the federation account that is distributed. Even earlier this year, the NMPC Director General also highlighted that the under recovery, which is used to pay for subsidy, would impact on what will be available for the FAC allocation.
Now, non-oil revenue seems to show high momentum. Do you think this is sustainable for the rest of the year?
Yes, I think it is sustainable, given the reduction in terms of the spread of COVID-19, as well as the improvement in vaccination. We've also seen that economies also open up, our businesses open up rather, and that would help sustain. So when you look at the non-oil revenue, we saw that impressive performance around the taxes. We saw the VAT, value-added tax, also increased. I think we're able to achieve about 207% performance within that space. Even custom duty, despite the trade challenges, they were also able to achieve close to about 80% of the target within that period. So for non-oil, it's possible for that performance to be sustained, but we also looking at more deliberate policies to drive productivity in the economy so that the tax can be boosted. In terms of collection, there needs to be a lot that also has to be done, because when you look at based on what the ability to collect or to generate relative to what actually dovetail to what is distributed, you still see that there's still a lot of gap. So it's possible for us to achieve very significant, very impressive record at the end of the year for non-oil sector revenue.
All right, let's look at the expenditure side. 4.86 trillion naira spent so far. Any call for concerns here?
I think there's a major call for concern. So when you look at the revenue base, yes, in terms of implementation, I think it's about 89%. But when you look at it vis-a-vis the actual revenue, so looking at the line item, so you look at debt servicing, this is about 1.8 trillion. I know that increase as a result of about 400 billion ways and means, interest on ways and means. That's the CBN borrowing to the government. They were able to pay out 428 billion naira within that space. That, when you look at actual revenue that was accrued to the government, was also around 1.8 trillion. So it means that about 98%, based on the calculation, about 98% of the revenue was used to service debt. You can see that it's very unsustainable. When you also look at personnel costs, it's almost about I think about 60 or 70% of net real actual revenue. So yes, it's good to project, but when you look at it based on the actual revenue, you will discover that there's really call for concern. And looking at when you look at the cost, capital expenditure, based on projection, projection is that capital expenditure will be about 30% of total expenditure. But at the end of the day, government has just disbursed or released about, I would say, spent about 978 billion naira on capital expenditure relative to 1.7 billion naira budgeted. And that is about 20% of total expenditure. So you will discover that the capital expenditure that has the most multiplier effect on the economy is the one that suffers the most. This is the one that benefits most Nigeria because it has to do with infrastructure, making easing business. So there needs to be a deliberate effort to see how we can increase the allocation and sustain, and for us to be able to open up the economy and also ease doing business in Nigeria. So when you look at the spending, right, you will see that we spend more to non-productive sector. So with 98% going into debt servicing, it means that almost, if we assume that what we have realized is being used, we deduct debt servicing cost. It means all other expenses in terms of paying salaries, we have been borrowing to do that, and also other non-debt recurrent expenditure.
As you mentioned, capital expenditure has continued to receive the least attention. What can we do to salvage this situation?
Okay, I think what it may give a bit of comfort is by the time we see the implementation of the new company called IFRACO, that's Infrastructure Corporation Company of Nigeria, which is said to be about 15 trillion. So that may help maybe bridge the gap in terms of our infrastructure. But we need to, government needs to see how you need to cut, first of all, governance, because most times if you want to view the government like a business, if you are not earning as much revenue and you are unable to increase your ability to earn the revenue, then you need to reduce the cost of doing the business. So I would say the cost of doing the business is governance. So for us to be able to have much of what Nigerians can benefit more from, which is the capital expenditure, then there needs to be a reduction in that element. Yes, borrowing, I would say that we shouldn't borrow, but most of the borrowings it should be deliberate. We should move them more to productive sectors so that we're able to generate cash flow that will be able to pay in the future.
So, based on budget performance, what's your expectation for the rest of the year? And is this trend sustainable? And how much of, growth impact should we expect?
Okay, thanks. In light of the continued rise in crude oil prices, that will continue to increase the amount of oil subsidy that government will have to be paying, which will reduce the available resources. What we are reviewing now is just between January and May. And when you look at oil prices have increased by maybe another 10% between that time and now, it means that the amount of subsidy payment would also increase. Based on our estimate, we are projecting about 1.6 trillion if subsidy is not either gradually removed or removed. It means that a lot of those resources will not be available. And it means borrowing. When you look at the budget deficit, which is currently about 3 trillion based on the first 5 months, it means that there's still going to be a tendency that deficit will increase significantly. So it's really not looking pretty very, very good. We need to ramp up the non-oil sector in terms of non-oil sector revenue in terms of collection, so that we are able to bridge and reduce the gap. If not, based on the projected budget deficit, would surpass that.
All right, thank you very much for your time with us this morning, Ayodeji. Thank you, we do appreciate it.
Always my pleasure.
Ayodeji Ebo is the head retail investment at Chapel Hill, Durham. And for Monday opening call to the market, we have Anete Edet there. Well, Anete, talk to us about the currency market. Where are we as at last week?
Morning, Jimmy. For the currencies market, for the forex, at the forex market, it's not looking too good. The dollar, the naira is still falling against the dollar. And then, of course, if you let me start first with the INE window, forex window. It was down by 4.11%, and that's because there was a drop in the sales of derivatives and at the spot market. So that's why we saw total value fall to about 584.54 million units. Then, of course, when you zoom in on the at the BDC forex window of the market, it was down by 1.21%. Of course, the naira is trading at about nearly 500. Was around 500, but is currently at 500. Then, of course, NAFEX, same thing. Well, no, so the NAFEX is up. For the volume of turnover, we had only the forward segments of the market making an uptrend there. It was up by 8.52%. Now, crossover to the fixed income market, we saw the bonds there, the bonds aspect. It was bullish, as a matter of fact. We had number of deals there, 25 all across board was positive. Same thing for the treasury bills. Of course, the CBN did an auction yesterday. They rolled over about 81.7 billion naira worth of treasuries there. And then, of course, no activity at the central bank's special bills. And for the OMO, well, we're still looking out for this week's turnover. I would have had an FX trader to talk to us about it. But then when we cross over to the stock market, yes, the first half, the first quarter, and the first month ended in the green. But of course, year to date, we're down by still at around 5%. But taking a look at last week, we were up in spite of some profit taking. It was a switch in between the bear and the bull. But of course, the bull came victorious, 1.47%, and that was largely driven by the consumer goods sector. But we'll go back there. So now the volume of transactions there was higher in contrast to last week. Value also the same, but the deals was on the downward side. And like I said, it was the consumer goods sector. Take a look at it, 5.14%. All the same for other sectors except the oil and gas sector. But to give us a closer look at the market, let's talk to Rotimi Fakaejo, who is a stockbroker at the Nigerian Exchange. Thank you for joining us, Rotimi.
Good morning.
Yes, I'm sure you're happy that the month of July, although for the market it started just last week, Thursday, and then of course it's been tilting in between the bear and the bull. We're still, year to date, we're still negative, but month to date, we're positive. So now, what do you think is driving this market?
Well, what's been driving it are various developments within the market. One of it is the release or approval of 7 derivatives by the Securities and Exchange Commission to be traded on the Nigerian exchange. This definitely is going to deepen the market and widen investors' choice of securities to trade in and also lower their risk. Secondly, also, the investors are looking forward to release of half-year results of companies, so they are well positioned for it. Having seen the first quarter, which was quite interesting, and I believe strongly that we're going to see a better half of the year for the year as we have started this month of July. And also for that, I foresee a situation whereby the trend is going to be such that we are going to quickly erase the 5.11% year-to-date negative trend, and we go into positive, because quite a lot of developments are going to come further for the market. And we are still looking forward to a situation whereby the exchange, the Nigerian exchange, is still going to conclude the Africa's first exchange-traded derivative. And that also will add value to the market and also broaden the number of securities available for trading. So I believe all of these are going to be in tandem to actually work together. For year-to-date, I think we've traded well over 1 trillion naira value, and I think the better part of the year, which is the second half, we're definitely going to see a much higher. So should be really optimistic about the market trend, and I believe that definitely they won't have anything to regret over this.
Okay, so we know that when the market is down, it means different things for different people. Of course, when it is down, it is bad for some who invested, and it is good for those who want to invest. And now we have some analysts say that we expect some profit taking to hit the market, especially when we enter the first full week of July. So what's your view about this, about the forecast for this week?
Well, I don't really foresee that, because if you look at it all, there is really no upward swing towards the end of the month that is significant, except maybe for the last trading days that we saw Dangote cement inching up with about 1 naira. And I think that was just about the only security that actually maintained that trend. But we should also know that it came all the way down from 230 to close the month at 229.98. So I think there may not really be any anxiety or apprehension concerning profit taking. But I believe that it is still a good time for investors to take advantage of the low prices of some securities that have good trend of dividend payment.
So thank you for bringing us up to speed with the markets at the NGX, Rotimi. So that was Rotimi. That was Rotimi Fakaejo, who is a stockbroker at the NGX. So now let's move over to the unlisted securities market. Of course, it also has been down 0.14%, of course, and then of course investors there lost about 76 billion naira, and then the total volume of shares there 1.57 for the week, value 1.05%. So Jimmy, so that's it for the market. We look forward to how we need to keep our fingers crossed for how the market will perform.
Absolutely. Well, I want to share Rotimi's optimism there. And of course, I heard him advocating for buying the dip. We'll see how that goes. All right, we take another break. And when we come back, we do an opening call to London. To stay with us. And the future of Morrison hangs in the balance this morning as the prospect of a full-scale bidding war for the UK's third-largest supermarket chain breaks out. Let's talk to Juliana. Good morning, Juliana. Apollo Global Management, the U.S. private equity group, has confirmed this morning that it is in the early stages of considering a bid. Now, this raises the possibility of a three-way battle for Morrison's, doesn't it?
It does, Chimezie, and what an interesting period that Morrison's is going through. Morrison's, they are the UK's fourth largest supermarket, one of the biggest private sector employers in Britain. They have over 118,000 staff in the UK, over 500 stores. And we had a discussion a couple of weeks ago when another private equity firm, Clayton, Dubilier and Rice, put in a bid, an unsolicited, surprising bid of £5.5 billion. That was swiftly rejected by shareholders. They didn't feel the price was high enough, but there were concerns, initially concerns, that it would attract more offers and perhaps there would be a takeover. And that's what's happened over the weekend. Fortress Management, pretty big investment firm, they also own Majestic Wines. They put in a bid of £6.3 billion, as well as paying off some debt worth £3 billion. And it was accepted. It's been accepted by shareholders over the weekend. That was a breaking news. And then we heard this morning that Apollo, a rival investment US firm, is also interested in Morrison's, though they haven't yet addressed the board. And now there are other mullings going around about Amazon potentially also being interested. They already have a deal when it comes to deliveries with Morrison's. So it's all up in the air. Nobody knows for sure what's going to happen, but investors are certainly happy. Morrison's is one of the biggest risers on the FTSE 250 this morning, as it has become attractive. Separately, Unite, they are the biggest workers' union here in the UK. They are in intense discussions trying to ensure that the over 100,000 staff's working rights are protected. But, you know, it's been a good 18 months for retailers here in the UK, particularly food retailers. They've done exceptionally well, and Morrison's are obviously reaping the benefits from that.
Another corporate news, John Lewis has announced plans to move into the residential property market by building 10,000 homes for retail over the next few years. Why is John Lewis doing this?
Yeah, this is an interesting story. According to a statement, John Lewis is saying they're doing it to try and fulfil some of the some of the desperate housing shortage needs here in the UK. But of course, beneath that headline, they're doing this because they've had a pretty tumultuous 18 months, even before the pandemic. John Lewis were almost struggling, trying to battle with a new generation of shopper that likes to buy stuff online. And for the first time in, well, since their history, at the year to the end of January, they posted losses of over £500 million. Last year, Chimezie, we spoke about John Lewis seeking permission from Westminster City Council to turn 25% of their flagship store just a couple of metres away from where I am on Oxford Street into offices. That was accepted, and they've gone further down this road. They said that they'll be building 7,000 new rental homes on existing John Lewis sites, and the rest, they'll be renting out these properties. If you're lucky enough to bag one of these properties, then it will be decked out in John Lewis furniture. So it is an interesting shape and turn for them, but they are struggling. They did say that they are going to be having some rapid turnarounds to try and make them profitable again. And for them, they've obviously seen that there is a surge in interest in property in the UK, and they want to tap into that market.
All right, I guess you have more updates for us later on Business Incorporated.
Thanks, Jimmy.
Let's look at the crypto market. Hey, Ladi, so what's happening in your market today?
Well, still have Bitcoin ranging between the 28K and the 36K region, but on Monday it's actually red. We have Bitcoin at 34,000 and most altcoins also in the red. Just a couple of stable coins we can see in the green. So it shows that investors are running into stable coins at this moment. Market cap, $1.44 trillion this morning, down about 1.09%. Then 24-hour volume is up at 5% this morning. Bitcoin dominance, 44.85%. It's been ranging between this 40 range for a while now. Price of Bitcoin this morning, $34,327 at 8 a.m. 24-hour volume traded, $26.47 billion traded. We see volume is inching down when it comes to Bitcoin and most of these altcoins. We have, looking at the 4-hour chart, we see the price resting on the simple moving average, the middle line of the Bollinger Band this morning, and we have a bearish cross on the MACD and volume is actually sapping out. So it's looking rather weak this morning, Bitcoin. Price of Ethereum. Ethereum is doing well, $2,285. It did get up to $2,300 over the weekend. It's up 2.42% this morning. 24-hour volume, $19.84 billion traded. Volume in Ethereum is also inching down. Top alts by market cap. We have Binance Coin, $300, up 3.80%. Cardano bulls are in the market right now. Taking Cardano to $1.42, up 3.13%. Doge, the meme coins are not doing well, thanks to maybe Elon Musk. Down 4.82%. XRP down, at 3.57%, but still below the $1 range. We have top 5 gainers. SNX, $9.13, up 23.33%. And GRT at 76 cents, up 12.22% this morning. And Zinfin, XDC, 11 cents, up 8.19. And we have AVAX there, $12.33 at 8 a.m. this morning, up about 5.93%. Take a look at the top 5 losers here. We see Decred, $135. It's had a good run, but it's down 6.61% this morning. Internet Computer, my eyes have been on this one. Did come out at $700, but look at it now. Trading at, it got as low as $28. And now we see it at 45. So if you entered at 28, you'd be up at least 100% right now. But it's down 6.28% this morning. And we have CeeLo there at $3.23, down 4.86%. And Engine Coin, Engine has had an incredible run this year, $1.14 at down about 4.77%. Well, but for Bitcoin now, top support levels to watch. We have strong support at $28,880 for Bitcoin. The second support is $24,217, and the third support, $19,846. But for resistance, we have strong resistance at $42,000 for Bitcoin, and the second resistance is at $50,000. But generally, Bitcoin is looking weak in this at this point. We have JP Morgan calling for $25,000 Bitcoin. Many analysts believe Bitcoin is actually going down. But you know, the funny thing about Bitcoin, you cannot really predict its direction. It could surprise traders. It could go up. But for now, alt season seems it's on hold for now. But let's see if we can bring in Olumide additional now. Hello, Olumide.
Hello, Raji. Good morning.
Good morning. Great to have you, Olumide.
Yeah,
so I see Ethereum has been making big moves over the weekend, got as high as $2,300, and a lot of pundits are calling for Ethereum to flip Bitcoin at some point. What's pushing sentiment?
Yeah, really what's pushing, there are a lot of macros pushing Ethereum right now, if you consider the fact that it's going under so many upgrades. The most recent is the London fork upgrade, which will at some point improve its functionality and the gas fees. So what we are saying is that institutional investors are keen on the assets, and the fact that the recent upgrades from to proof of stake is showing that it has so much earning capacity in regards to staking. And JP Morgan, one of the world's most valuable banks, recently said that this would really trigger institutional buying pressure. So we are seeing that it has broken above 2,200, despite the fact that Bitcoin is still moving critically below the support level of $35,000. But market watchers will preempt that it's too early to say if Ethereum can keep on the buying pressure. But the altcoin has posted gains of about 15% for the week. So that kind of position in the next time.
No, but generally, you know, volume is down, you know, with Bitcoin, Ethereum. Does it show there's not much interest at this time?
No, that's not really true. You know, over the past 3 months, we've seen volume dumping. Yes, you might be right in terms of volume over the midterm, but I think recent pressure is just that we're trying to see that retail volatility has reduced. And what we are seeing right now is that you could see that price has been fluctuating like before. So institutional buyers are venturing deep by deep. And you should forget that the Chinese clamped down on Bitcoin really weighed heavily on the market sentiment. So the bullish buyers are just trying to trickle in big spots. I think volume has improved back to back, because if you look at the last 1 week, over $3 billion worth of Bitcoin was bought from exchanges. So that's really a strong bullish sentiment right now. But the thing is just that we're not getting that buying pressure we saw in April. So a lot of people are weakening that the sentiment. But I think it's growing right now. But, you know, it could pull back based on market reaction.
All right, Olumide, quick one. Is 64K the top?
Yeah, I think so. This year, I think 64K is the top. I don't see us getting this close. But the fact that a lot of macros are still coming ahead, the stiffer regulations, the fact is, despite the fact that many countries are adopting Bitcoin as a form of tender, I don't see it rallying that high, because that pressure, that buying pressure we saw this year, it's going to take a lot. Yeah, so I think the market will cool off. Yeah.
All right. Even though many believe 100K is still in view. All right, thanks, Olumide.
Yeah, thanks, Al.
All right, Jimmy, there you have it.
I don't believe so. I don't believe that 100K view. And by the way, with Ethereum still, you know, below 3,000, just wondering how that is going to even flip Bitcoin.
Because I've never seen Ethereum flip Bitcoin before. I don't know where they are, you know, getting this.
A lot of magic happens in this market. You never can
yes,
tell.
it does. Who could have seen BNB flipping XRP? But it did happen. So who knows?
Absolutely. All right, that's it on the program. Thank you for watching. I'm Chimeze Obi Iwago.
And I'm Ladi Williams. Thank you for watching. Don't forget, Business Incorporated at 1:30. Goodbye.